WealthTech is focused on investments. So where there is an investor and there is capital invested and there's technology related to investing the capital, managing portfolios, doing research and insight, creating reporting for an investor, that's what I would refer to as WealthTech. So there's a saying in software sales, no pain, no change. The same in venture investment and in terms of are they going to be able to get an existing customer doing something today to flip to you. Product market fit is a process, it's not an endpoint. So you're always going to be adjusting and investing in your product to increase your product market fit. So everyone arguably has some amount of product market fit. It's just a relative number versus your competition and regarding their other options.
Welcome to the Diligent Observer from PitchFact. I'm your host, Andrew, and every week I share insights and strategies to help angel investors make better bets. My guest today is Marshall Smith. Marshall is a seasoned wealth tech investor and corporate development leader with over 18 years of experience in wealth tech, fintech, and software as a service. He is the managing director of First Rate Ventures, the corporate venture capital arm of First Rate Incorporated, the global leader in data aggregation, performance, and reporting solutions for over 500 wealth managers, family offices, and asset managers across 5 continents. Marshall currently leads the strategy and execution of minority investments in early stage wealth tech startups, as well as majority acquisitions of successful wealth tech platforms globally. He also co-founded and serves on the advisory board of WealthTech Strategy Partners, a boutique advisory firm that helps early stage wealth techs. Additionally, he's a co-founder, board director, and accelerator selection committee member for the Founders Arena, a unique and first of its kind go-to-market accelerator for wealth tech companies. Marshall holds the CIPM credential from the CFA Institute and has published multiple white papers on risk management and performance measurement. He's passionate about fostering innovation, collaboration, and impact in the wealth tech ecosystem. Marshall currently lives in Southlake, Texas with his wife Shannon and 4 kids. They are involved in business's mission, adoption, and foster care ministry, and actively serve in their local church. Marshall, thank you so much for being with me today.
Yeah, it's an honor to be here and excited for our conversation.
Likewise. So my first question for you, Marshall, I am not an expert in this space, so I'd love if you could just tell me, what is wealth tech? Like, what does wealth tech mean?
Yeah, great question. So I get this a lot. Most people track with the term fintech. So financial technology generally is referring to software as a service businesses in the financial space. Wealth tech is a subset. So fintech is the wider, broader industry. And fintech includes wealth tech, it includes insure tech, it includes payments tech, and some other areas as well. Wealth tech is focused on investments. So where there is an investor and there is capital invested and there's technology related to investing the capital, managing portfolios, doing research and insight, creating reporting for an investor, that's what I would refer to as wealth tech. Some people also think about investment tech or invest tech as a separate element, but I think wealth tech is a trending term. A lot of people are galvanizing behind it as the technology related to investments.
So would you say wealth tech specifically describes capital once it's been deployed, like the management, upkeep, eyes on capital post investment?
Yeah, that's part of it, but I would say pre-investment as well. Wealth tech is anything in the investment process. So if you think about investment process, if I'm a professional wealth manager, it starts with meeting a prospect and understanding their risk tolerance, their goals, their objectives, their financial plan. There's a lot of financial planning software out there that a professional wealth manager would utilize. And then it goes into, okay, once you understand the risks, the goals, then it gets into portfolio construction. How do I create an investment portfolio with equities and bonds and alternatives and potentially some direct investments? And I want to mix those together to best align to the goals, objectives, and risk tolerances of my customer. So then I've got to trade and actually put those funds to use. And so there's the management of that. Then there's compliance to make sure your portfolio is in alignment with the stated goals that the client has. And sometimes regulators want to come in and check on that, make sure that you're doing that appropriately. And then there's all the reporting and communication elements to the customer to say, "Hey, these are your risk tolerances, these are your goals, this is the portfolio we put in place, and this is how it's performing versus market benchmarks and alternatives." And a lot of that reporting gets into justifying the wealth manager's fees and expenses and producing an ROI for that wealth manager. So anywhere from meeting the customer and tech related to understanding the customer, all the way to the end of the spectrum, which is reporting back to that customer about their investments. That's what I would bookend in terms of WealthTech.
So help me understand how and what you described as investment tech fits into that. Is that the more of the underlying mechanics of executing the trades? Like, how would you describe investment tech in relation
Yeah.
to
Some
WealthTech,
people,
which you just walked
yeah,
us
some
through?
people leverage the term invest tech or investment tech to really be about research and building portfolios. So there are some people in the space who all they do is build a pooled vehicle. Think of it as like a mutual fund manager. And they are doing research. They're trying to do fundamental or technical analysis on securities. And think of a Bloomberg terminal as being an example of invest tech that is not necessarily connected to wealth management. Wealth management is the process by which a individual does for themselves, because there is like the DIY version of wealth tech. And then there's also the business driven or B2B version of wealth tech, where a professional is actually making a living providing that service. So I would say InvestTech really focused on choosing the portfolio, researching the portfolio, the analytics around that portfolio, and the financial statistics around the companies in the portfolio.
Super helpful. So you're clearly deeply involved in this space and highly specialized. How did you first get involved in the wealth tech universe?
My career started here at First Rate, which is a company based in Arlington, Texas, and it's in the wealth tech space. They've been around 34 years now. And so my first job was an intern here many years ago and just started learning the business. And their customers were banks who had a wealth management business. And First Rate does the data aggregation, the performance reporting, and the client reporting part of wealth tech. And although they didn't call it wealth tech until the last few years, we just called it wealth management software or investment software. And so I learned the business by just being a part of it. And I started as an analyst, an intern, then I was an analyst, which meant that I took all the data from the customers, loaded it into our software, and helped produce all of the client reporting results that they were looking for. And so through that, I learned the investment space. Started reading the Wall Street Journal. I studied for the CIPM exam. I started understanding what wealth managers do, how they do it, and how all these investments performed. So the beauty of this sort of a business is I've seen every type of investment. I've seen every type of transaction. I've understood how all of these securities work on a fundamental level. And so learned how the sausage was made, so to speak. And have just had the pleasure of having different roles within the company: client service, P&L management, ran marketing, sales, was a chief product officer. So through that, I really understood what we did in context of what everything else a wealth manager needed. And I started becoming friends and we became partners with many other vendors in the space. So I started learning how they worked and their differentiators. And so really over this 17 to 18 year period that I've worked here, I've just built up that knowledge of the space. And then the last 3 years or so have been focused on the venture space, which is our own corporate venture investments, where we're looking at investing in early stage wealth techs that are strategic to us. And so really, I think of myself as an operator in the wealth tech space. That's my first 14 to 15 years of my career. And the last 2 to 3 years has been as a strategic investor in the space, leveraging my operator mindset to think about what would be successful in launching new ventures and how could we help as a strategic investor.
I want to come back to some of your current work and specifically in the venture world over the last few years, but think back with me for a second to that first few years when you joined as an intern and then as an analyst. I'm curious, what were some of the lessons or some of the things that surprised you during your first few years as you began to learn about this ecosystem?
Yeah. Now, I assume you're referencing just the wealth management business versus the venture ecosystem. So, the wealth management business, I just never understood the different types of securities that were out there. And in particular, a lot of the packaging of alternatives, structured products, and other derivatives, swaps, and other things like that. I just figured investments was just like owning a share of Microsoft or having a loan. So I had simple constructs of like what investments were and how they behaved. And then when I got thrown into this analyst job, my customer was a top 10 bank in the US, and they had, I don't know, 50 or 60,000 clients who were invested in their portfolios that they managed. And some of those clients were really complex and large and had a lot of complex investments. And so really, I think probably the thing that I really learned over the first, I don't know, 3 to 5 years was that there's an infinite way, a number of ways to invest. There's an infinite number of products and services you can invest in, and they have a lot of different outcomes. And some of those outcomes, like even pricing, some things don't price for over a year. Some of the venture investments, for instance, often don't have a new mark to market. Some of them might do every quarter, some of them might do every year, but that's just because there's a requirement to price every year, not because there's actual liquidity event or investment that would signify new investment value. So probably just seeing the complexity of the space and the types of investments, how they behaved, and how everyone was getting vastly different outcomes was really the thing that I really learned a lot about in my early years.
Really interesting. And so I'm curious, as you've transitioned over the last 3 to 5 years into kind of an investor perspective with the operator's hat in tow, what are some of the things that have stuck out to you about being on this side of the table as you look at opportunities? Like, what are the things that you've learned over the last few years that come to mind?
Well, I think as an operator, one observation I have now looking back is that I learned a lesson that clients have a never ending list of things they want. You get unending list of product feedback. I wish the product did this. I wish the product did that. It would be really great if you had this kind of report or this kind of statistic or this kind of user experience. And now that I've transitioned into venture investing, you hear a lot of the same things, and you hear it referred to as product market fit. And every venture investor is seeking to build a platform that has product market fit. And what I would observe as being an operator in a business who I would argue had product market fit, in that it was already scaled. When I joined the business, it had 50 plus customers, 10 plus million in revenue. Product market fit is that product market fit is a process. It's not an endpoint. So you're always going to be adjusting and investing in your product to increase your product market fit. So everyone arguably has some amount of product market fit. It's just a relative number versus your competition and regarding their other options. And so my point there is a lot of new ventures will cast I need $1 million to get to product market fit. And my advice is you're never going to quite be there. You're always going to be reinvesting to get there. So don't imagine a world where once you get to product market fit, you're at break even or cash flow positive, and then you can just milk the product for cash flow or return. You're going to have to continually maintain your product market fit. And that's a key learning that looking back, or as an operator, I observed in that my customers were never fully happy. And then two, if you gave them the things they wanted, it didn't necessarily mean that they valued it enough to pay for it. So my point is people will tell you endless things that they want, but if you put a price tag on those things, you actually find out what they're willing to pay for. And that's a key lesson learned also, I think, with new ventures is they get early customers, beta, design partners, comes by a lot of different names, and they're giving them feedback, which is incredibly valuable. The challenge is what part of their feedback is something they'd be willing to pay for. Because if you can't add that element to your feedback, so to speak, or your understanding of the customer, you'll have a never ending list of things that they need or want. So my point is you've really got to incorporate what they're willing to pay for.
So how does that shape or influence the way that you evaluate opportunities coming across your desk? I think that's a fascinating insight and one that is very confusing for a lot of entrepreneurs, right? They're told to go get product market fit and then come back, or we only invest post product market fit,
Yep.
things like that,
Yep.
right? It's very abstract and difficult to understand. Given what you just shared, how does that shape the way you evaluate opportunities hitting your desk?
Yeah. So I think one, we have to heavily discount any future projection when the operating costs of the business are higher than the revenues of the business. That's essentially in our business called the burn. So businesses are raising capital to burn that same capital to create a product or service that will eventually generate more revenue than expenses. I mean, that's the general plan. Now, some people, they exit the business in the sense that they sell it before they ever hit break even. So there are some businesses that are really just technology speculation plays. If I can just prove that this technology works or this customer use case works, I'll then just sell it to the next person or strategic who might value it just for that alone. So really, you've got to understand what's the game plan of this startup. Is it to never break even in the sense of all I want to do is prove something and then exit? Is it to build a product or service that it will eventually break even and then will operate for an unknown period of time as a cash flow positive business? Or is it to be even more conservative than that? It's basically to never burn capital and only bootstrap, meaning that the expenses of the business have to be less than the revenues. And oftentimes that means founders and workers work for free or, work for equity, essentially equity value in order that they don't need to burn any capital. So my point is, as I look at different investment opportunities, I'm really trying to understand where in the spectrum is that entrepreneur and what problem are they trying to solve? And as an operator in the business for the last 17 years, I've seen a lot of other people try to solve many of the problems that are being presented, or I know of multiple companies already solving that problem. And as someone who's deeply immersed in the space, I can kind of combine what's their outlook? Are they bootstrappers? Are they get to break even? Or are they just show revenue or traction and then exit? Combined with the industry expertise of are other people solving this problem? Are there competitors? And what are the problems that their competitors have run into? Because often I'll meet a green entrepreneur who says, oh, well, investment advisors don't have enough tech to manage their clients' portfolios. And if they use more tech, they'd be more efficient, be more profitable. Therefore, they'll pay for my product. I hear basically that sort of pitch a lot. And I just sit back and go, I know tons of tech that people or tons of platforms that make that same value proposition. But there's lots of problems, there's lots of challenges, and then really question the entrepreneur into how are they going to solve the different challenges that I see everyone else being faced with in the industry.
I wonder if you could walk through maybe a recent investment that you led or were part of and just kind of explain your thought process as you hit your desk, you met the
Yeah.
entrepreneur, like maybe just walk through a recent example
Yeah, for sure. So,
that you think would be
yeah,
interesting.
I think I've got maybe two or three investments that we've done recently they're actually all really different. And this is the benefit of being a corporate venture capitalist is that we can invest for lots of different reasons, strategic reasons, ROI reasons, financial reasons, and every deal can be a different justification for an investment. So it's good in the sense that I can look at almost any deal that crosses my desk is an opportunity. And it's really bad in the sense that every deal that comes across my desk is an opportunity. So I don't get to focus as much on the very size, type, check size focus that a lot of venture investors do, or a lot of angels groups might do. One is our most recent investment, Fispoke. This is actually a pre-revenue deal, pre-revenue, pre-product, very experienced team in an industry solving a problem that I've personally validated is a problem in the industry. And they're going to approach it in a novel way. So they have no revenue, they have no cash flows, they have no customers, but they have a team who've been deeply immersed in this problem for a long time. And there are a couple of different competitors out there competing with them, but they're trying to solve the challenge different ways. And so this is an example of a very speculative bet. It's early stage capital. This is generally where the angel groups come in, otherwise known as friend families, and sometimes fools come in at the very high risk stage. And you're really backing an entrepreneur's idea. They haven't proven it yet. And that's why they're coming to you for capital. And they're really leveraging the trust or relationship with you to where you're really just going to bet on that. Because most of the investors in the space, and angels in particular, aren't going to be experts in that space. You're relying heavily upon their experience. So that's the deal with Fispoke. Now, we are a professional investor in WealthTech, so we could do a lot of underwriting and validating of that thesis, but we decided to invest in them regardless of the traction and as a speculative bet that they can solve a problem in the space, which is essentially providing banking services, products, and loan type services to independent advisors, such that the independent advisor brings white labeled banking products to their customer, and the customer only knows the RIA. They actually don't have to have a contingent, potentially competitive relationship with a bank who also wants to provide them the same services that the independent RIA is providing. So the way that they're going about that technologically and strategically is unique.
So it sounds like Fispoke really stood out to you all based on your industry experience. They have a problem that you don't see clearly met in the industry today. And then they have a team that deeply gets it and is experienced in the space. And those are the two kind of core reasons.
And there's a third very important reason. What they needed to build, we had a lot of experience building ourselves. And so we actually brought a lot of know-how to the table in terms of how to build an application or a software platform that would communicate with these banks' APIs and with the WealthTech platforms that the RIAs are using. And that industry insight actually got inserted into the business. So when we became an investor, we brought the strategic insights, and we actually brought a team who could build some of those aspects of the platform to the table. So we weren't just, here's some money, we hope you're successful. It's, here's some money, here's some talent, here's some know-how, and here's some strategy, and inserted all of those into that investment. And so that's how we hope to be more successful than the average investor, because we are a strategic investor.
Love that. Okay, let's go to the second one.
Okay, so Al
rolling.
ESG. So this is one of our first deals. We invested two and a half years ago. And this is a company, interesting history. They were selling ESG scores for investments. And this was pretty hot, in particular about in the last 3 to 5 years. Big growing trend to do impact investing. Some people in the space might refer to that value-based investing, faith-based investing. It has a lot of terms, and it's been around a long time. And they had a initial product, and they actually had traction. They had about $1 million of ARR. They had big name customers, and they'd been around like 7 to 10 years already. But they had a vision to take the initial product and move to a 2.0 version of the product, where they were going to use AI to collect and ingest documents for public companies, and that they would actually sell the raw data insights about those companies. And so this is an interesting company investment opportunity where we really accelerated their next stage of growth into a second product category, backing an entrepreneur who had proven that he could sell to enterprises, proven he could sell to large banks even. And we were able to back him in his second go-to-market with this AI-based data solution. And very similar to the Fispoke deal, we actually had some insights on how to go about building that application, and had some team who could be a part of it as well. So you're hearing an interesting theme here, where we get involved when we believe in the entrepreneur, or we believe in their product strategy, but where we can also, in addition to capital, bring in strategic insights and some product capabilities as well. And that company continues to be successful. ESG has had some challenges, in the sense that in the US in particular, there's been an anti-ESG mindset. And that's kind of wrapped up their brand a little bit, because they've really become a broader data company, financial data. It's not ESG focused. So it's had some headwinds and challenges, but that's been a great investment for us as well.
So Marshall, how would you contextualize that theme of contributing value and adding beyond capital? How would you suggest an angel investor think about ways that they can do that? Because they're not going to have a team typically. They're not going to have a huge amount of extra time to bring to the table. What would you say to an angel investor about leveraging their expertise and their skill set to help an entrepreneur succeed, and to even win a spot on a cap table when there's competitive dollars out there?
Well, one, I think angels do have the opportunity to provide strategic value add. The ways I've seen that work is oftentimes in an angel community, the benefit of the community actually is that there are experts in a number of different industries, a part of that angel group. And if the angel group is looking to invest in, say, a fintech, you might have some angels who actually have experience in fintech. Maybe it's from business development. They were salespeople in fintech. Maybe they were operators. Maybe they were software people. Whatever it is, you want to really, I think, catalog the various skill sets and insights your group has. Similar to what we would do with First Rate. We would look internally into our business to go, what resources, what insights do we have on this space that we could leverage to make this investment successful? And then what I've seen angel investment groups do is in certain cases, they do get board roles or board observer roles so they can have a lot of insight into what are the challenges that the CEO and founders have. And then they can go to their angel community and say, these are the challenges they're facing, whether it's pipeline development. Okay. Who is their target customer and what network do we have to be able to provide introductions or insights into operations, finance, capital raising, et cetera? How can our angel community group help make this business successful? And so, one, I think you're going to be wanting to look for a company who values that partnership, values that advice and insight. Frankly, if they don't value that and they're not interested in that, then you really isolated your support to be purely financial. And at that point, the question has to be asked, how are we differentiated in providing capital? And if we're not adding any other strategic value adds, what's the likelihood of us having an outsized return or a more positive return than the average investor would? But that would be my advice in approaching it is approach it with, here's our strengths, here's our network, here are the insights that our group has, and trying to find companies that value that.
I want to pivot topics a little bit because I know you have been very active and First Rate has been very active working globally. I'd love if you could share a little bit about the international work that you do, and then maybe some lessons learned over the last few years working with the global workforce.
Yeah, great question. So First Rate's core business, we have customers on 5 continents. We have operations on 4. We started in Arlington, Texas. That's our North American headquarters is what we would say today. And probably 90-ish% of our revenue is North American based still. We've had some recent expansion through an acquisition of a Santiago, Chile based company called Finantech. And they've become part of the First Rate business. And now we are growing throughout Latin America through that deal. In 2020, we acqui-hired a team in Pune, India that were AI experts with a history in WealthTech. And we started building new products and services related with AI technology infused into them and delivering those to the market. And that has been a really successful growth curve for us. We actually started before that with some operations, outsourcing software development and other technical and data center related work to an office in Kabul, Afghanistan with software developers was our first offshore office. And then Hyderabad, India started in about 2013, which I was involved in helping start that office. And we actually have customers in the UK as well and throughout Europe through both organic business growth and then also through some investments and acquisitions. And so, yes, we've kind of rapidly developed a global footprint. And that's part of our strategy in the venture team is to proactively identify investments that would further diversify our business globally. And on the venture team itself, I've embraced that in that my first associate hire was from Pune, India. And I started off as an intern. And my own mindset was, if we're going to be investing globally, I want to have a global team that's supporting me. And brought on that person as an intern, started giving them research, bringing them up to speed on the market. And she just did fantastic. And it further demonstrated, because I had already learned this lesson as an operator, hiring analysts and interns for our core business, was that talent is not regional. And there are incredibly talented people around the globe that have given an opportunity to contribute, can generate a lot of value for the end customer and for the business hiring them, and actually bring unique perspectives to the table that you don't necessarily get when you have one culture focused sort of team. And the fact that we wanted to cover Asia, the Middle East, and Europe with our investments meant having someone who worked the opposite clock and understood a bit more of Eastern cultures was a strategic value add. And so since then, that person has risen the ranks and she's now a principal on the team. And we have another associate in Pune, India, who works with us One of them has moved. The principal now lives in Dubai. So he was able to cover that market and help us really go into that market itself. And I'm a big fan of what I call impact sourcing. And impact sourcing really involves identifying a location where employing someone makes an impact, period. And it makes an impact because it enables them to increase their professional level, increase their earnings power, and make an impact in their local community. And First Rate has a very much an impact focus. Our values are love, give, serve, and enjoy. And wherever we employ people or wherever we have an office, we actually find ways to impact the community through our nonprofit partners. And we have a 10% giving pledge that we do on our revenue. And that goes into all the communities we do business. And so just tying all those things together makes a real impact. And I found the team members and people who've been on the team have been able to contribute substantially. And I continue to source team members for the First Rate Ventures team globally.
Do you primarily focus on talent sourcing globally, or do you also look for investments globally? I know you mentioned an acquisition in Chile recently. I'm curious, are you primarily focused on US-based wealth tech opportunities, or are you also exploring global?
I would say we get plenty of deal flow from the US. And part of that is because First Rate's been around a long time. We've known a lot of people. So when we launched our venture fund, people just naturally came to us looking for investment or strategic advice. We've had to be more proactive to source international deals. This year, we've been very focused on Asia Pacific, Middle East, and mainland Europe. Those are three markets where there's a lot of wealth management businesses, and there's a lot of movement in wealth to those regions. In particular, the Southeast Asia and Middle East, that there is a wave of tech needing to be built and regionalized to support those money movements. And so we're very focused on identifying investments globally. So far, we have acquired two businesses that are in global regions, and we've acquired a third that had a significant global customer base. And that's very much a proactive strategy of our fund, is to help diversify the business from a global perspective.
Love that. And I'm sure has been a blast to see that impact as you've gone to visit and worked with these local teams.
If you like global travel, you like making impact, hire someone on your team from a global region and just make them a part of your team and then go visit them. So this summer, I went on a 12-day trip. I went to Singapore, Hyderabad, India, and Pune, India. Actually circumvented the world, just kept flying west. And it was an incredible time. I love meeting and working with my team in person. I love seeing their culture, their location, their community, meet their families, and make that a part of business. And at First Rate has a culture of a relationship-oriented business philosophy. So being in relationship, not only with your coworkers, but your coworkers' families as much as possible, creates the context of really being able to understand people, where they come from, the stresses that they maybe have, and really their motivations. So, why they work, who they work for is an important element. And being able to connect those dots and care about those things truly makes your relationships at work more substantive.
Love that. I want to come back to the angel perspective, and then I have one final question for you after that. If you were sitting in a room with an angel investor who was new to WealthTech specifically, maybe they had some context for fintech more broadly, but were really interested in learning more about the WealthTech universe, what would be the 1 to 3 key questions that you would encourage them to consider when evaluating an opportunity?
Yeah, probably some of this advice is probably more generic than specific to wealth tech. But as I look at opportunities, I want to think about in the wealth tech space specifically, who's their target market? Okay. So in the wealth tech space, there's enterprises, large banks in particular. These are the hardest to do business with. It takes the longest amount of time, often 12 to 18 months or more of a sales cycle, and are incredibly challenging for early stage companies without a strong balance sheet and profitability to do business. The largest banks and largest enterprise wealth managers in the US are allergic to doing business with startups. Now you might say, well, that's why their tech is so backwards and old. And when I want to work with my bank, they say, walk into the bank instead of using the app. But that's a real thing. And it's because they're risk averse. And so in the wealth tech space, the large enterprise customers will be risk averse. The independent RIAs are the easiest to do business with. These are registered investment advisors. Anyone can set up an RIA and invest on behalf of their friends and family. And these are like small practice lifestyle businesses. They start there and then they build into enterprises over time if they want to scale. Those are the easiest to do business with. They're the smallest check size and also very price sensitive. So the challenge, my point in the wealth tech space, it's so critical to understand what is the startup's target persona and target customer. And if they say the word enterprise and they say, well, we want to do business with big banks because once you get in a big bank, it's hard to get out. You need to understand, are they prepared for the long sales cycle that it will take to be successful in that space? And then two, the thing I'd be really focused on is, and it relates to the first question, is how much capital have they raised? What's their burn? How much runway do they have? Because if they don't have sufficient runway, any regulated business is going to have a hard time doing business with you. And then third, I think understanding who else is working. If you're going to go and build a financial planning product, well, what's going to be different than the other financial planning products? And second, why is someone going to change? So there's a saying in software sales, no pain, no change. It's the same in venture investment and in terms of are they going to be able to get an existing customer doing something today to flip to you? And I've seen a lot of startups go out the space, build a better product. It's more efficient. The UI is cooler. It works better on an app. It does all these things that sound great. But then they go, you know what? I've been using this system for 10 years. I've got so much history in it. So much, everybody knows how to use it. Jack over there, he's going to retire in 3 years and he won't change the software. There's all of these barriers to change in the space that you've really got to be cognizant of and to make sure your product or service provides so much more value that it's going to overcome that. From what I can tell in the wealth tech space, that comes from products that generate revenue. If you're a cost to a wealth tech to a wealth manager and you're going to do it for cheaper or you're going to do it for better, you're going to have a harder time winning customers and getting them to change than if you're a product or service that actually would help them generate revenue. If you leverage my WealthTech service, you're going to win customers at a 30% faster clip or a 30% increased chance of winning a new business or new customer, which means revenue in the door. So revenue generating product and services are more successful in being able to grow.
My last question for you, Marshall, is you're incredibly involved in the local ecosystem. You've founded multiple companies recently. I'd love if you could share a little bit more about your current work and how our audience can stay connected to you.
Yeah, absolutely. One, we like to interact with angel groups. So we're based here in Arlington, Texas. We've hosted a number of WealthTech showcases where we've invited entrepreneurs to come pitch. And we've been friendly with the Baylor Angel Network as well as the Horn Frog Investment Network. These are two angel groups here in the DFW Metroplex, or have a lot of people in DFW Metroplex, and we've included them in our WealthTech events. We do an annual event called the WealthTech Combine that's going to be hosted right here by Cowboy Stadium, where we invite WealthTech entrepreneurs to come and pitch. We'll have WealthTech experts come and speak. I'll be hosting a panel. This is October, I believe, 8th and 9th here in Arlington, Texas, where we'll be having this event. And so if you're in the DFW Metroplex, if you're in Texas or you just love WealthTech, it's an open invite. It's related to the Founders Arena as a 501c3 global WealthTech accelerator, which I'm on the board of. And we attract these companies from around the globe to come and be a part of our events and programming and an accelerator that's associated to it. And so that would be my main plug for how to get involved, is to start attending some of these ecosystem events. You can actually, if you work at a wealth management shop or bank, you can actually have a virtual R&D session with the companies in the accelerator. So that's another great way to get plugged into these innovative wealth tech companies, is the Founders Arena is already curating them. We do have the events like the showcases and the combine, which are in-person physical events. But then we also do virtual sessions where these companies and these founders pitch for 12 minutes. I mean, it's very short. Their value proposition to a wealth management business. And they can, in a 3-hour period of time, get pitched 6 innovative wealth tech companies and provide feedback to them and potentially do business with ones that can help them. So those are some real practical ways to get involved.
Well, Marshall, this has been incredible. Thank you for taking the time to share with us today. And I'm already looking forward to our next conversation.
All right. Enjoyed it. Have a good one.